Hello guys, welcome to this new module. So today I'm going to show you how to use the VIP Forex Signals so you can benefit and make an additional stream of income. So getting started with it, here are the three things that we're going to cover. So the first is the types of trade orders. Second, calculating the risk per trade, and third, managing the trade. So the types of orders that we're going to take, there's two type of orders: market execution and pending orders. So what is market execution? Is when an order is filled at the next available price, and the trader just needs to specify the volume, so the risk, meaning the lot that it's going to use, and the bid and ask price of an asset is generally is generated during the execution process. With some brokers, stop loss and the take profit levels can only be added after the trade has been opened, with the price when the price is known. To simplify this, it means that when you click, it's when you click buy and sell, and when you see that your position is open within a few seconds, really fast, because there's so much liquidity, sorry, into the forex industry. There's so much money, trillions of dollars, literally, that when you click buy and buy or sell in your either in your laptop broker platform when you open a trade, or using your phone, you click buy or sell, it literally opens a position really fast. It's this kind of execution. It's a market execution. It's when the next available price and that you want it is available, meaning that there's so much money, there's so much liquidity that it's available within seconds. So that's the first type of order. Then we have the second type, which is pending order, which is a pending order is an instruction to open a position when the current price reaches the order level. And there are four types of pending orders that I mentioned in here. But in the VIP Forex Signals, we're only going to use limit orders. So buy and sell limits. I just put the buy and sell stop to make a recap and show you the whole all the type of trade orders. But we are only going to use market execution when we publish the trade on the VIP Forex Signals group, and that you have to take as fast as you can, as instantly. When we post it, you take the signal, and depending order, we're going to publish it at the specific price in the future at which we want to open it, and it'll be a buy or sell limit. So the first thing you want to do before opening a trade is determining your risk, so calculating the risk per trade. But before doing that, let's go to the VIP Forex Signals group on Telegram, and I'll show you here the two type of trades that you get. So as I mentioned right here, we have a market execution order, a regular order. The one you're going to have 90 to 95% of the time is just a regular buy or sell that you take as soon as possible when it's published right here. And we have the pending order, because right here you can see it's a limit order, it's a sell limit. So I'm going to show you how to take these two type of trades. And you can see that every trade includes the currency pair, AUD/USD in this case, the direction buy or sell, in this case buy, the entry price. Since it's a market execution order, we put here the most optimal price that we want to enter at, meaning we're going to enter at this position, and when we share this trade, it'll be preferable for you to enter at this price. If you enter 1 to 3 pips after or before, like 0.6873 or 67, it's all right. But I mean, we post the most optimal price which we recommend to enter. We have the stop loss value, the take profit number 1 value, TP number 2 value, and occasionally we're going to have a take profit number 3. So in this case we have one, TP number 3, which is a long-term target. So we have right here the trade plus. As you can see right here, we have the image, the chart analysis. So if you click on it, you're going to see it bigger, and this is a really beautiful thing, because you're going to see the analysis of a professional trader, in this case Nick. So you're going to learn, and by default, with time, like weeks and months passing, you're going to you're going to learn a lot of things, how to place your trend lines, your support and resistance, and the zones and the Fibonacci's, and so you're going to learn a lot. This is a very valuable component. So you have the chart analysis in here. So all these components that I mentioned, and the same for the pending orders. So same analysis, entry price, the currency pair, the direction, if it's a market order, market execution, or a pending order, the price at which to enter, stop loss value, take profit number 1, number 2, and occasional take profit number 3. So, and the chart analysis right here. So now that you know this, I'm going to make an hypothetical example. So I'm just going to do as if I was going to take that trade. That was a previous trade on January 7th this year. So just redoing the process of taking a trade. So the first thing you want to do when you take a trade is calculate your risk per trade before. So what you do, you go on MyFixBook position size calculator, so which is a calculator. The position size calculator calculates the required position size based on your currency pair, risk level, either in terms of percentage and money, and the pips, the stop loss in pips. So as you can see right here, we can go on myfixbook.com, that most of you might know by this, might know at this point. MyFixBook, you go on home and you go on Forex calculators, and then you select right here the last option, so position size calculator. And as you can see right here, as mentioned, so there is account currency, in this case USD. I have my hypothetical account right here, a demo account with $100,000 US, 100K. The account size, so I'm going to put the account size. You don't want to put a space. I just did the space to show you that it's not going to work afterwards, but you don't want to put a space. Whether you have $100, 1,000, 100,000, 1 million, you don't want to put a space. And as mentioned here, you have the risk to reward, the risk ratio, how much you're going to risk, either in percentage, or you can click switch to money, but don't ever click on this. Money doesn't mean anything. It's always the percentage, the gain or the loss in percentage that matters. So percentage, it's what counts. So we're not going to use this. And you want to risk a maximum of 5% per trade. It's not that we're recommending to risk 5%. It's just the maximum. You should not look above this, because a higher risk per trade than 5% is gambling, literally. Like, traders with experience, whether it's a few months or many years into the game, know these kind of proportions. Just above 5% is ridiculous. It's gambling, because losses will accumulate very fast, especially during losing streaks, making it really easy to blow an account. So if you risk more than 5%, and you lose 5 trades, it's already more than 25% of your equity blown. And if you just lose one more trade, so 6 trades in total at more than 5%, it's already more than 30% of your equity that it's gone. So you don't want this to happen, because you want to protect your hard-earned money, of course. And you have to divide your risk by the number of positions that you want to open. So when entering a trade with more than one position, let's say you don't want to aim for TP number 1 only, you want to aim for TP number 2 or number 3. It's crucial to divide the risk by the number. It's crucial to divide the risk by the number of positions opened. Otherwise, it'll systematically mean doubling the risk. What do I mean by that is that when you open a trade, in this case 100K, let's put the maximum 5%, never to switch to money, always in percentage like this by default. The stop loss in number of pips. How do you calculate the stop loss? The stop loss pips that you're going to risk. You go back to the trade and you just get out your calculator. You get out your calculator. In this case, it's 0.6870, 0.6870, 1, 2, 3, 4. So this is the unit of pips. This is the pipette, the fifth decimal. So it's the pipette. It's not a pip. So that's why I said 0.6870. It's 70 because this is the pipette, the unit of pips, 1 pip in here. This is worth 10 in the tens of pips, hundreds of pips, and thousands of pips. So right here, you want to determine the stop loss in terms of pips. So the entry price minus the stop loss right here is value 0.67.6749. It's 121 pips because 1, 2, 3, 4. As I said, the fourth decimal is the unit. Then right here, every time to the left is 10 times bigger. So unit, tens of pips, hundreds of pips, thousands of pips. So hundreds of pips, 121 pips that you're risking. That's it. That's how you calculate the risk. And what you do with this, so you input it in here, 121 pips, and the currency, so AUD USD, and then you click on calculate, and you see that it says it's not a valid number because you have a space. And you click calculate once again, and you see money USD, so $5,000 represents 5% of this amount, in this case 100K. Units, we don't care about this. And the lot, so we have a 4.132. We don't care about this last decimal, the two first decimals, right? So 4.13 decimals to 4.13 lot that you're going to risk. That represents 5% of this amount at this number of pips that are at the risk as stop loss. So 4.13. So let's say you have one position, as I said, one position. You just want to aim for TP number 1. You just click, you open a buy or sell order, and you put the 4.13, and that's it. But let's say you have two positions. You want to aim for TP number 1 and TP number 2. So TP number 1 right here, and TP number 1 and number 2. What do you do with this? You don't open two orders. So you open one order, a buy, you put everything, the stop loss, the take profit number 1, and the lot 4.13, and you open another order with the same stop loss, of course, and TP number 2, and not the same lot, because if you put this twice, it systematically means that you're risking twice. This represents, as I said, the value, the lot for the elements computed in here. So it's 5%. This represents 5% of this amount at this number of pips at risk. So if you compute it twice, you'll be risking 10%, and you don't want this. So you actually want to divide this by 2. So what do you do? If you're not good with math, I know what it gives already, but if you're not good, you will compute it right here with the calculator. 4.13 divided by 2, it equals 2.06. 2.06, you don't want to round up numbers. There's a 5, you don't want to round it up to 2.07. You let it as it is, and you take the 2.06, and therefore if you have two positions, you take two positions, and you put the lot 2.06 in this case, because each trade, each position, and in this case you have two positions, it's worth 2.5%. So 2.5% plus 2.5% gives 5%. So two positions worth 2.5% at this number of lot, 2.06. All right. So don't forget to divide your risk, otherwise you'll be doubling your risk systematically. And therefore, what do you do? So I've determined my risk, and what do? I go to my broker's platform. In this case, it's not like a downloaded version of the MetaTrader 4, MT4, because I'm using a Mac and it didn't allow me to, but it's the same thing if you have like a laptop, a PC specifically, and you downloaded the MT4, it's pretty much the same thing. So when you first define your risk, then you want to take the trade, AUD USD right here. You go on the top left corner of the screen, and you'll see this paper with the plus, which is labeled new order. You click on it, and you have the symbol, the pair, AUD USD, and the lot, 2.06 in this case. that I was calculated, 2.06. If I have two positions, if I only have one position, it's 4.13 as and you just put the stop loss and the take profit number one, and you click buy, and that's it. You have one position, and this will represent 5%, as it was shown right here, 5%. But if you have two positions, of course, you divide the risk by two, and it gives 2.06, and you input the stop loss. So in this case, you can input it manually, or you can just copy paste, but you always check, you always double check up. So the stop loss right here is 0.6749, right? Take profit number one is right here. Take profit number one right here. That's it. So you have the currency pair, the volume. So this is half of the lot that was given. So it's a position worth 2.5%. Stop loss, take profit number one. No comments. Market execution, because it's just a simple buy that was shared in the group. And you click on buy. In this case, it's not going to work because the stop loss is supposed to be higher than the current price, right? The price right here is supposed to be higher than the stop loss, because if we're having a buy, then if it goes in the counter direction, it goes on the downside. But as you can see right here, the price is at 0.66, so it's below the stop loss. So if I click buy, it doesn't let me enter. As you can see, it doesn't show like the order, but in your case it will show you, because this signal was a previous signal, like given on January 7th, so a few weeks ago. So that's why it doesn't work, but it'll work, of course, in regular conditions. So that's how you take a trade. So by dividing your risk, that's how you do. And therefore you have, that's for a position of 2.5%. And if you have, of course, the other position of 2.5%, and the take profit is take profit number two. So you do the same operation. You open after the first position, the volume, half of the volume, the same stop loss, of course, always, and then take profit number two. Take profit number two, market execution, and buy once again, and then you have two positions that will be shown right here, and you have two positions with 5% risk for both combined, and that's how you do. And then what's next with this? So you manage the trade. How you manage the trade? So stop loss at break even. When a trade hits take profit number one, you put the stop loss to break even, to with the entry price, meaning that you'll be risk free. So at this point that there's two positions, there's two orders right here. You see the two positions, and boom, one closes because it took the take profit number one. What you want to do from the moment that it takes the take profit number one, the remaining one, the only one that will be left right here, you put the take profit, you put the stop loss to break even, to the entry price. At this moment, you will be risk free. So if for the second position, price just aims towards TP number two, and boom, it reaches back to your entry price, stops you out at break even, you'll lose nothing because you were risk free. And in the further example that you have a take profit number two that is taken, you'll be taking some partial or full profits on the trade. So if at the beginning you enter a trade with two positions, take profit number one is hit, stop loss at break even for the second position, and the take profit number two is taken, you're already out of the trade. You won the trade because you only had two positions, so you took already full profits. But if you're having a take profit number three, which represents a long-term target, usually hundreds of pips away from the entry price, by aiming at it, you have to respect previous risk management. So in this case, you have three positions. When the second position is taken, you can either close the third one, the take profit number three, if you feel like it, or if you want to hold it to expect maybe price to reach it, do as you wish. But that's how you do it. So take profit number two taken, and you have three positions. you take partial profits, or you close everything. And take profit number 3, as I mentioned, is a long-term target. Usually right here is that you have the entry price at 0.6870, and the take profit number 3 is at 0.73. So it's like 400 pips, even more away from. So many pips away, hundreds of pips away. So that's why the take profit number 3 is a longer term. And now show the same process for the pending order. So the GBP/USD sell limit in this case, what do? Of course, you determine your risk. You don't put the separate space right here. 100K, I put 5% risk, and in this case I'm going to compute once again the stop loss in terms of pips at risk. So 1.9070, 1.9070 minus 1.9185. That's 115 pips at risk, 115 pips, and that's on GBP/AUD. GBP/AUD, and that's it. So $5,000 represents 5% of this amount, and if I open one position with 6.49 a lot, it represents 5%. So if I want to, of course, have two positions, aim at TP number 1 and TP number 2, you have to divide this by 2. So 6.49 divided by 2, it gives 3.24. So 3.24, you go back on your brokerage platform, new order, GBP/AUD, GBP/AUD, or you just switch right here, GBP/AUD, right here, GBP/AUD. If I have two positions, of course, 3.24. If I have three positions, you should divide the 6.49 by 3. But two positions, I compute the stop loss, I input the take profit number 1, and in this case, I go in here, type, and put pending order. And what type of pending order is a sell limit, as you can see, sell limit. So I put sell limit, and what's the price at which we want to enter? So it's this price right here. So you copy it, or you enter it manually. And then, you put everything, the stop loss, the take profit, pending order in this case, not market execution, sell limit at this price. You don't click on expiry, nothing, just here, and then you place the order and it's going to be triggered. And you do the same with the second position. So that's how you do it, guys, with the VIP Forex Signals. And therefore, a last word right here is that from a really well-known trader, like in the 90s, during the 70s, 80s, and 90s, old school type of traders, like a legend in the trading world, said Paul Tudor Jones. And then at the end of the day, the most important thing is how good are you at risk control, so risk management. 90% of any great trader is going to be the risk control. So divide your risk. If you have more than one position per trade, you put your stop loss at break even after the first take profit is hit, and then you either take partial profits after TP number 2 is if you have two positions. So after TP number 2 is hit, you'll be out of the trade as a winner. If you have if you had three positions because you wanted to aim for TP number 3, so after take profit number 2, you either close everything or you let it run at break even, the third position for take profit number 3. And that's how you do it. And occasionally we're going to have some comments right here, like if we put a pending order and then a few hours later it hasn't been triggered, we might say like, okay, cancel this order. You have to cancel it before it's triggered, because if it does, and we set it because market change or something, and you get triggered, you're probably going to lose. So pay attention to every single comment that we say in the group, and by following the rules that I just mentioned, I don't see why you would be losing, other than if it was a loser trade. But except of that, if it's a winning trade, then you lose. It's because you're not doing something well, right? So I hope you enjoyed this module, and that you'll collect a lot of pips and money. So enjoy, guys. See you in the next video.